Gabriela, welcome to London. Brilliant to see you here. The OECD has been leading some of the most important work in the world looking at rising levels of inequality. But just tell us a bit about why we should be worried about inequality that's bigger now.
Well, because I think it has reached levels that are unsustainable from the societal point of view. If you think about the cohesiveness that our societies need to function as a unique body of people that are looking for certain objectives in life, this increase in inequalities is creating a sense of division, a lack of trust that is impeding countries to evolve in a more sustainable way, let's say. But let me tell you something else, because we are an economic institution. So if it is morally wrong from that perspective, from the societal perspective, we have also seen that the levels it has reached, it's also hindering growth. Because the bottom 40% of the population that have not seen the standards of living improved, they never fulfill their full potential. And so if you are really just in this utilitarian kind of how do I take advantage of my own assets, where you're not investing in them, you're not investing in the skills of your people, you're not investing in the infrastructure of laggard regions, you're not investing in all the potential that the economy have in their people, because they're just lagging behind.
So higher levels of inequality are actually slowing down rates of growth.
Totally, and that's something that we have just seen. This happens through the human capital accumulation above all, because lower levels of income bring lower levels of education. Families invest less in the skills of their children, and therefore there's lots of capacity that you are wasting and that the economy is not taking advantage of.
And as you look at the last 20 years, can you see factors which are driving up inequality? Are there things that you can pinpoint to say that's causing more inequality?
Well, I think it's the whole model of growth that we have followed. At the OECD, we also launched the new approaches to economic challenges, because we thought that we were just looking at the efficiency of markets. We were over-relying on markets to address all of the issues that we were concerned about, and we just neglected the question of distributional outcomes. Now we know, by looking just at the average, GDP average, and focusing only on material well-being, we neglected the fact that that growth was being unevenly distributed. When you look at the distributional impact of the policies we take, then you see that the bottom 40% is just lagging behind totally. Second, we have, of course, the question of competition and the regulation of the financial sector, for example, but also the fact that we have been building this idea that you grow first and then you redistribute. Tax and transfer system is just to redistribute and to help those. Social safety nets is to cut those that fall. And therefore, the fact is that we were not looking at building up a system that was benefiting everybody together. Now we know that we have also technological changes that have impacted those that are less prepared to confront them or to take advantage of them. And therefore, there is this compound accumulation of disadvantages of certain groups that we didn't even take a look by only focusing on efficiency of markets. So what we need to do is to broaden the discussion and bring the multidimensional well-being of people and the distributional outcomes that would allow us to get a more fair distribution of the benefits of growth.
So what are some of the answers that OECD is beginning to point to? If we want to fix inequality, if we want to bring inequality down, what are some of the things that seem obvious to you from where you look at things?
Well, there are very simple issues, such as changing the measurement tools that we have. If you just focus on the averages, if you just focus on material well-being, then the whole story get completely blurred, which is what happened to us. We were very happy growing at 5%, 10%, 8% in the emerging economies, but we were not looking at the distributional impact of that growth. So I think that we need to change the tools we use. We need to focus on people, not on production, not on consumption, not on GDP. Focus on well-being of people, how the standards of living are improving, and the distributional impacts of the policies we take. I think that's very important. And it will be more important because on top of the impact of the crisis, on top of the trends that have created this high inequality of income, opportunities, and outcomes, we are now facing the impressive digital progress that is also going against those that are less prepared to take advantage of it. So we call it the productivity inclusiveness nexus. Productivity is slowing down, not for everybody, because we have demonstrated that those firms at the technological frontier, they continue having productivity growth of 3-5%, but the laggard firms are completely flat. What it's telling you is that, again, those at the top can capture the benefits of growth, the benefits of technological progress. They have this sorting out of attracting the best skills from the market. They pay well, they train those skills, and then they leave the rest out of there. So the mindset is, how do you focus on those at the bottom, not with assistantialist transfers, because that doesn't work, but with those support systems that will enable them to succeed. And so we completely agree with Dennis Snauer from Kiel Institute to have an empowering state. Change the mindset of the tax and transfer system. Change the mindset of looking at the bottom 40% as someone that you need to protect. You need to enable them to thrive in this global economy. And then you need to refocus our policies for people and not for just GDP or GDP growth.
And alongside a more enabling state, are there new rules that you need in the marketplace as well?
For sure. I mean, we just went from one extreme to the other. We thought that markets will just figure it out. They will tend to equilibrium. We have representative agents. We have rational choices. And all of those paradigms are completely crashed with the crisis. So we need to rebuild also the economics profession and the way that the policy decisions are taken based on economic models that have false assumptions. And so that's the other part of the new approaches to economic challenges, that we need to bring back but the whole dimension of people's well-being, of what they are interested, listen to them. It's not only about, of course, having your wallet is important, but thinking that your children will have a future, having good social connections, having cohesive societies, having empathy, having, I mean, all these things that we are losing in our societies are as important as having a good job. So all these dimensions are very important to bring back in the equation, and that's why we need to develop, I would say, a new narrative for growth, a new narrative for caring about people, and changing those instruments. And you know what? I studied in Harvard in the heights of the neoclassical economics, and they used to say, if the economic models that usually were very quantitative with all these assumptions that we found that are flawed are not capturing reality, just change the reality. I think that the reality reached us very harsh, with very hard political consequences. So now I would turn it around. I would say, if the model don't capture reality, throw the model. Trust your judgment. Look at history. Look at sociology. Look at psychology. Try to understand better what matters for people to take the best decisions.